Great. Welcome. Good afternoon. Thank you for dialing in to CT Private Equity Trust as part of our Ideas for ISAs series of presentations. We have Andrew Carnworth here, who is the manager of CT Private Equity. He's actually due to take over as lead manager from the AGM of from May 2026, when previous manager retires. A bit of housekeeping first. If anyone's got any questions, please do click on the bottom right hand corner. You'll see a question mark box. If you type your questions in there, I can then address them to Andrew at the end. Thank you very much indeed, Andrew, for joining this, and without further ado, I'll hand over to you.
Brilliant. Well, thank you very much for having me. It's a lovely spring day here, and I'm delighted to provide an introduction to CT Private Equity Trust. So I'm going to give a bit of an overview of the trust and the strategy, touch on historical performance, the current portfolio, and then look at some examples of current and recent investments before opening it up to Q&A. So at the risk of blowing our own trumpet, let's start with a few awards that the trust has won. The trust was launched 27 years ago, and it's listed on the main market of the London Stock Exchange. And it's been managed by the same team since inception. Last year, the AIC recognised the trust as the 9th best performing investment trust over the last 10 years, which was great. Oh, sorry, move these slides. So when you look at private equity, it benefits from 3 key features. Firstly, the opportunity set. There is a huge pool of innovative private companies in which to invest. Now, to put that into perspective, if you look at Europe and North America, which are our key markets, over 90% of companies with revenues of 100 million plus are private. And that percentage is growing all the time as many of the best companies increasingly choose to stay private for longer. Private equity also provides access to many high growth niche companies and new business models not available in public markets. Secondly is the approach, which is both long-term and active. When it's done well, private equity is a true partnership with company management teams. It combines financial and human capital to drive operational improvements and accelerate growth. And this approach enables long-term planning and investment with less emphasis on quarterly results. And then thirdly, and importantly, are returns. Over the long term, private equity has significantly outperformed public markets. And I believe it will continue to do so given private equity's structural advantages. Now, private equity has historically mainly been the preserve of large financial institutions and ultra high net worth individuals. But CT Private Equity Trust aims to provide easy access for all investors to a well-diversified portfolio of high-growth private companies. The trust targets long-term capital growth and income by investing in high-quality, small and mid-sized private companies at attractive valuations. We target an even split between fund investments and direct investments. providing a well-diversified portfolio of over 500 companies. And these are sourced through our large and well-established network of expert private equity managers. So the private equity universe is large and complex, so I thought worth highlighting where we focus. On this slide, you can see various types of investment in private companies, with companies maturing from the left-hand side of the slide to the right, from startups through venture capital to growth capital and finally buyout investments. As companies mature, so the risk reduces and the consistency of returns increases. Now, our focus is very much on buyout investments. So in established companies with proven technology and business models that are profitable, growing strongly, and with proven management teams. Within the buyout sector, we focus on smaller, higher return deals. We focus on the lower mid-market, and we define that as companies with an entry value of up to 500 million. This is a very, very large universe of high growth entrepreneurial companies with very low penetration by private equity. It's less competitive and intermediated than larger markets, and it favors regional and sector specialists who are able to build relationships and trust with management teams over a period of time before partnering with them to accelerate the growth of the companies they invest in. In this part of the market, investments can be found at very attractive valuations, and returns are primarily driven by growth, not by financial engineering. Now, the portfolio has been constructed with a consistent strategy since inception. We're looking for companies with leading positions in attractive and growing markets, with differentiated and proven products with high barriers to entry, entrepreneurial management teams, high margins, strong cash generation, and proven track records of growth. And these companies are backed by experienced private equity executives at attractive valuations. Growth is then accelerated and value created through a number of repeatable strategies. And these include investment to accelerate growth, strategic M&A to consolidate markets and add capabilities, refinement of commercial strategies, strengthening management teams, geographic expansion, digital enhancement, and improving ESG practices. This strategy has delivered consistent and reliable returns for over 25 years. And as you can see on the slide, it has significantly outperformed public markets, returning 3.6 times the gains of the FTSE All-Share since inception. The trust also pays a consistent and growing quarterly dividend, with a current dividend yield of about 5%. It was also recognised as a next generation dividend hero by the AIC, having grown dividends every year for over 10 years. Now, it's no secret that M&A in this sector has been depressed over the last 3 years. Investor confidence has been low, due to geopolitical risks, and as a result, there have been fewer exits and distributions to investors. But despite the difficult environment, the Trust achieved about 50 exits last year, and those returned an average of 3.3 times cost. As you can see on the slide, they were also at a 24% uplift to holding value. Now, this uplift on exit provides comfort that valuations remain prudent. But importantly, it also shows that when that exit environment improves, it should drive not only an increase in exit volumes, but a substantial growth in net asset value if those exits are at a premium to holding value, as they have been in the past. So let's look quickly at the current portfolio. So while listed markets have become increasingly concentrated in a few very large companies, we believe that diversification is critical to mitigating risk whilst retaining strong upside potential. The portfolio is therefore well diversified by sector, geography, year of investment, and lead manager. The portfolio is also prudently valued at 10 times enterprise value to EBITDA or earnings, and modestly leveraged with net debt to EBITDA of 2.5 times. The portfolio is growing strongly with average revenue growth of 17% per annum and EBITDA growth of 24% per annum in 2025. Now, investments are typically made with an anticipated hold of 5 years, and the portfolio is continuously refreshed through a cycle of investment, growth and value enhancement, and divestment. So on this slide, you can see the top 10 holdings within the trust, which together represent 24% of net asset value. So a good mix of companies in different geographies and sectors with no single company dependence. Let's dive into a couple of those. So looking quickly at Cyberhawk, one of the top 10 holdings. It was founded in 2008 and it has pioneered the use of drones to inspect critical energy infrastructure, enabling more efficient, safer, and more accurate inspection. It's also created its bespoke software to enable asset owners to see the status of their assets and to use the huge amounts of data created through drone inspections to make informed decisions and efficiently maintain their assets. We invested in Cyberhawk in March 2019, and we were attracted to the company by its clear leadership in the sector, its blue chip customer base, and the belief that the drone service market was at an inflection point and poised for very rapid growth. I'm pleased to say that since then, the company has grown very rapidly, and it's now working with the likes of large US utilities to inspect their transmission lines and prevent wildfires. It's also recently expanded into other areas, such as inspecting data centers with the likes of Meta. I think it's a really exciting high growth company at the intersection of robotics, software, and AI. And it's a good example of the type of business that just isn't available in public markets. Another top 10 holding is Cardo. Now, this company was founded in 2012 to provide high quality maintenance and repairs to the UK social housing sector. We invested in March 2023, and since then, Cardo has grown revenue and EBITDA at an amazing over 100% per annum. Through that, it's become one of the largest social housing maintenance providers in the UK and Ireland, and it continues to have huge scope for further growth, both in the UK and overseas. So turning now to an exit, Dotmatics is an example of a recent exit from a co-investment. Dotmatics is a software company that's used by R&D research scientists around the world to enable collaboration within laboratories and between laboratories. By doing that, it drives efficiencies and reduces the cost and time required to develop new drugs and vaccines. We sold 88% of our investment back in 2021, and the final part of our stake was sold in July last year to Siemens, and this returned an excellent 8.3 times cost and 79% IRR, or annual return. Now, interestingly, Siemens acquired Dotmatics to form the core or a core component of its AI strategy. And I think that demonstrates the strong upside potential to our portfolio from AI. Finally, let's look at a couple of new investments. So Kepler Capital 4 is an example of a fund investment. It's a UK lower mid-market fund that targets technology and life science companies based in the UK. It's a good example of our long-standing strategy of backing emerging managers. Now, what do I mean by that? I mean recently formed private equity firms that have recently formed private equity firms that have been established by experienced private equity executives, typically that we know well. We focus on identifying and backing these up and coming firms early, forming strong partnerships at a formative stage in their firm's development and building relationships which will hopefully last for decades. Now, we invested with Kepler since its formation in 2013, and since then we've invested in 3 previous funds and 3 co-investments. And it's a good example of an emerging manager that has performed very strongly, with our 2 realized co-investments, Jolly's, a pet shop, and ATEC, a specialist insurer, returning a combined 4.9 times cost and 29% IRR. Now, in November, we made a new co-investment into Vanda Research. This is a market-leading data and information business serving the financial services sector. The co-investment is led by B2B software and data specialist FPE Capital, another high-performing emerging manager who we've backed since inception. And our co-investment was to help fund a transformational acquisition of Exante Data in the US. The acquisition nearly doubled the size of the company and extends its product offering. And post-acquisition, Vanda is a clear global leader in the rapidly growing market for position and flow data. Now, that's information used to understand how capital is allocated in listed markets and how investor behavior is changing over time. Its customers include major asset managers, hedge funds, investment banks, and even central banks. So, in conclusion, whilst the outlook contains significant risk, given what's happening in the Middle East, we believe that the Trust is well positioned to navigate these challenging times, as it has the challenges of the last 27 years. This confidence is based upon the strength and diversification of the portfolio and the value-added support of our investment partners. And we believe the Trust is well positioned to continue to grow value for shareholders. Thank you, and very happy to answer questions.
Thanks, Andrew. That's very kind of you. So if anyone would like to ask a question, then just a reminder, click on the bottom right-hand corner of the screen, and there's a question mark there. You can type your question in there. There are a couple here already. I've got one question about the income. Obviously, or maybe you just explain a bit more about where the income come from, and also the Trust's attitude to paying dividends.
Sure. So most of the returns from our investments are capital rather than income. That's how private equity is typically structured. However, the Trust was the very first trust to take the benefit of being able to pay dividends from a combination of capital returns and income. We see the dividend as a really important way of our shareholders benefiting in the strong returns that we realize, and we're very much committed to continuing to grow those dividends over time. The way that the dividend works is we aim to pay 4% of NAV over 4 quarterly dividends. So it's a very predictable dividend that's paid. And as I said, it's been growing for the last 13 years.
Fantastic. Thank you. The discount to NAV, there's a question here about what the board thinks about the discount. I mean, my observation is that CTP trades on roughly the same discount as the rest of the peer group. And the peer group do lots of buybacks, CTP doesn't. Is that something that they're thinking about?
Yes. So firstly, the discount is wider than we would like. I think what will bring that in is kind of confidence returning to the market. And we need to see that come through. The board are constantly looking at this, and we do use buyback selectively where we think that is in the benefit of shareholders. However, we think that the best way of returning capital to shareholders is through the dividend and keeping that predictable. And many of our shareholders use those dividends to reinvest at a discount, and therefore minimizing the impact.
Fantastic. A little question about your how you invest into these smaller private companies, and maybe you can give a little bit of info about how much access to management and the information you have before you make an investment, because obviously private investment being it's a long-term investment. And I guess the follow-up question is, how much influence do you have when it comes to sell? Is there are you making the decision to sell, or is it someone else?
Yeah. Okay. So there is a whole spectrum in this, but if we kind of look at it on the sort of basics, in terms of fund investments, we're really looking at what is the strategy of the lead manager, what's their track record, why do we think they have a right to win? And by that, I mean, it's important to remember in private equity, you can't just choose which businesses you want to invest in. You need to persuade management to allow you into the company, to partner with you rather than any other group. So in those funds, we're looking at that lead manager and the strategy. We will then back them and to execute that strategy and identify the companies. So at the point of our investment, we don't know which companies, but we know the strategy. By contrast with our co-investments, we're looking very much at specific companies before we invest. We have a lot of access in terms of due diligence. We'll be looking at commercial due diligence, financial due diligence, ESG, tax, etc. We will meet with management teams and form our own sort of assessment of them before we go into those companies. Going forward, it depends. On some companies, we may take observer seats and therefore sit in the boards of those companies. In a few cases, we take board seats and we sit on the boards of companies. But it's always alongside a lead investor who's typically a sector or regional specialist. And then in terms of exit, again, it depends. Sometimes we will decide to roll part of our holding if we think there's more to go and there's an opportunity to do that. Otherwise, we're looking for the next opportunity. So it's a whole spectrum. So.
Fantastic. We've got two sort of slightly related questions because one of them is what's your view on the AI threat to software businesses and what's your exposure to software? But also another sort of related question is, are there any themes that your companies are exposed to that you're worried about? Maybe the second is pointing towards the first, but if there's any other themes other than AI, the SaaS apocalypse or whatever it's called, then be interesting to hear.
Okay, I'll maybe take the second part of that first because I think it's probably quicker and easier. So, anything we're worried about, I think geopolitics. That has been the biggest risk for a while now. When you look at the portfolio, we've got very limited direct exposure to the Middle East. However, the portfolio is exposed to the second order impacts of the war. I think at this point it's very difficult to predict the duration and the precise impacts of the conflict. But I do worry that if it is prolonged, then it is likely to reignite inflation and suppress economic growth. And I think that's a big risk. I take a lot of comfort, though, that the companies we're invested in, they're nimble, they're fast moving, they're supported by private equity executives, and they've shown the ability to adapt, for example, to the Ukraine war. I think that's the key sort of risk. In terms of AI, look, I think this is a fascinating area, and it's an area that we and our investment partners have been looking at for a number of years, trying to identify what are the risks and opportunities to each company that we invest in. I think there is no doubt that AI is driving a huge transition and transformation, and with that comes both risk and opportunities. Within our portfolio, software is about 20%. And I feel quite confident there because of the types of software business that we're invested in. We're very much focused on companies where there's proprietary knowledge and data, deep domain expertise, customer trust, and complex workflows. often the software is used in mission critical workflows and use cases, and I think that provides a real defensive moat. By contrast, I think the biggest disruption will be in very generalist horizontal software. So I think within the software market, there'll be great winners like the likes of Dotmatics and losers. And at the minute, I think the markets aren't really differentiating between the companies that are going to win and the ones that are going to lose.
Well, time will tell, won't it? But notwithstanding your point about the future being quite hard to predict, a good question here. How do you assess or how do you assess future cash flows and capital commitments for the trust? And do you model sort of stress scenarios?
Yeah, absolutely. So we model all of our cash flows in a lot of detail on an investment by investment basis. We're constantly updating those. And then, yes, we run stress tests against those based on sort of, what happened in the great financial crisis, based upon, what we think worst case scenarios are for different things. So there's a lot of modeling that we do. And then within the company, we have debt facilities and a revolving credit facility that we can use when there's any kind of mismatch between drawdowns and distributions. But typically, because any investment requires a buyer and a seller, you actually find that drawdowns and distributions are pretty well matched over time.
Fantastic. Maybe you could just quickly tell everyone what the current gearing situation is. But
yeah, so gearing is we've got about 90 million of debt, so gearing of about 16%, and we've got ample of headroom on our debt facilities, so over 50 million of headroom.
Fantastic. There don't seem to be any further questions from the floor, so I guess unless one pops up in a second, I'd like to thank you all for dialing in, but in particular on your behalf, thank you, Andrew, for taking the time to explain CT private equity. We have another presentation on Monday, where we have Black Royal Mining presenting at midday. Again, an extension of this series. But thank you so much for dialing in, and thank you again, Andrew. With that, I think we can close the presentation.
Brilliant. Thank you very much.
Have a good weekend.